interestingly enough, when I first got started really in the space and understanding the space, I met this actually was the guy that invented the super soaker. Okay, his financial guy, and what he invested in was services businesses. He invested in temporary. So he had invested in a temporary services business, and that had grown, and he liked it because he understood the business. So here's the thing to think about when you are, if you're in that particular situation. What is it that whoever you're targeting, what do they understand? Right? If they already understand your space, or understand it, in this case, potentially a customer that you're providing the services to, they already understand it, and they like your business because they're a customer and they understand the space and the value, and they go, oh, I believe that there would be a lot more people like me that would want your business if they knew about it.
Growing a business based on cash flow is challenging and can make it hard to scale because you don't have extra cash on hand to invest in people or systems. Knowing when to seek outside capital, the requirements before, during, and after, and how to find investors is critical when deciding when and if you sell equity in your company to potential investors, and what are the alternatives to selling equity. That's why in this episode, we are going to be talking about the types of business funding, either debt and equity, that are available to entrepreneurs like you and me. So I am joined by Karen Rands today. She is the leader of the Compassionate Capitalist movement, the host of the Compassionate Capitalist Show. Karen is also the author of the best-selling financial investment primer, Inside Secrets to Angel Investing. Karen is recognized as an authority on creating wealth through investing and building successful businesses that can scale and exit rich. Hey, Karen, welcome to the Master Delegator Podcast.
Hello, Kristy. It's great to be here. Thank you so much.
You're welcome. It's nice to have you on the show. I've never talked about business funding here on my show because I'm not, an expert of that. And I am currently bootstrapping my business right now. And I'm glad that I didn't really need to have a lot of capital, to build out my business. But I know, I think maybe 90% of the entrepreneurs that I have met that are doing B2B transactions, they are also bootstrapping, their businesses. So can you tell us when is the right time for us bootstrappers to seek help, or why do we need, to find investors, or do we even need one? I know that's a loaded question. Like one question with three questions. Yeah.
I do that all the time, so I should be prepared for that. The thing about it is, if you can do your business bootstrapping and get to a point where you're generating enough revenue to sustain your growth, then you just grow organically, and it's fine. The reason why you take on debt or an investor is because you have something that you want to do that's bigger than what your cash flow allows. And so you need extra money from some source. And similar to the way a lot of times people, bootstrapping, you'll do credit cards and things like that. But when it comes time to taking on like an SBA loan or something, it's like, oh, well, I have enough money to pay that loan. Right? Well, I have enough extra money. Now I got this. So am I generating enough revenue or enough extra business that it warrants, it's what they look for as well, but it warrants, taking on that burden of that. Similarly, if you're going to take on investor money, it has to be the questions you kind of have to ask yourself on should I or should I not is, what is your goal of what you want to do with your business? If people that are listening to it now, let's say they've invented something and it's creating a new market, or they've got something that's new that they're doing that not somebody else is doing right now, or not doing it in the same way, then there would be what you would call a market maker. And so then there's competition associated with that may or may not be direct competition, but they're kind of charting a new path. They may be wedging themselves into an existing market to garner market share, but there's got to be an expectation of an exit with that. That means that they're going to sell their company, at some point, and, or maybe because they're going to go so huge that they're going to be able to do a public offering, because the exit means that equity in the company, because when you take on an investor, you're selling a piece of your company to them. And so they are now a co-owner in your company. And then with that, they have certain rights. And that, depending on how you structure your offering of equity, then those rights become, they're part of that document. And at the very least, they have a vote in changes to the company direction and when you're getting ready to sell that. But they have an expectation that if I put $1 in, then I'm going to get at least $4 back when there's an exit. So you have to look at how big are you going to grow your business in order for it to produce that kind of return.
Right.
And so when you're exiting a company, the way they calculate that is that it's based on the industry, a multiple of your profit. Usually you do have, so that they call that EBITDA for those that are out there that have a little bit of an accounting background or bookkeeping background. So that's earnings before interest, taxes, depreciation. So it's kind of like your baseline profit kind of a thing. And some multiple of that is what is the acquisition price. And so that multiple then really kind of sets that, whatever, like that dollar then becomes $4 and they get $3 in profit,
right,
as a basic way to describe that. So it's really a personal question that an entrepreneur has to ask. Am I building this to sell it, and it's going to be that much bigger once I take on whatever additional investor or debt I'm going to have, right? Debt is, I'm going to be able to pay it, but also, if I'm going to exit. If their idea is that sometimes people, there, and is always a depends part of an answer, but so that's the basic premise of it. And so if the intention is, no, I'm going to build this and I'm going to do this because this is going to be my business, my lifestyle for the next 20 years, well, then you're not really a candidate for investor capital unless you structure it in such a way that it's not a piece of your company. Okay. So the way that worked, and not a lot of people, I talk about it in my book, for those that are watching my book, Inside Secrets to Angel Investing, I talk about this thing, and it's starting to become vogue again. It's been around forever, but hardly anybody knows about it, it seems like, or talks about it, because it's not something that traditional angel investors have looked at. But it's, if you've ever watched Shark Tank,
I love
Mr. Wonderful, and he talks about a piece of the revenue, a royalty financing, right? So the way that works, and that's been, I love it. He's a little aggressive in what he expects out of it.
He's a businessman.
Yeah, but usually the way it's set up, if somebody's got a good cash flow and whatever they're taking is going to go directly to generating the rest of the revenue, like sometimes they need to buy inventory and they can't get traditional financing for inventory. So they might go to an investor and say, hey, I need to get $30,000 to pay my chunk for purchase order financing and what the manufacturer requires as my down payment or my guarantee. And then there's this other kind of financing that facilitates that. And and they're going to continue to use this chunk, as something that is then used again and again and again for each purchase order. And so that now what that investor would say is like, okay, so my $30,000, I'm going to get 10% of your revenue until X amount of money is paid back. So instead of having an equity share, if they don't pay it, then it converts to equity, but then they would get, like $90,000 back over time, like on a quarterly basis. And usually we structure that so it's once you get to a certain level of profit, so you're not hurting your business trying to pay this person back in their multiple, So that's kind of, and there are some folks, some investors that will be the bank. So they will, instead of having like a chunk, they might bridge finance you through that inventory, because then they basically are getting 2% on their money, just like a factoring company.
What do you
And
call those
they
kind
roll
of
it over.
investors?
Rare.
Rare, yeah. Because I know there are angel investors, right? And there's another type of investor.
Well, so here's the thing. Angel investing is sort of this broad term that is used for, traditionally it's been for these big tech companies and big companies that, are going to be the next big unicorn, the Ubers and that kind of stuff. And they get in real, and they're young, and then they get a VC round, and then they go on
Yeah.
and do all this other kind of stuff. That's your traditional model.
Yeah.
And that has been really turned on its ear as a result of the Jobs Act that came out in 2012 that legalized crowdfunding for equity. So now people may decide, oh, you know what? I'm going to go out. I'm not going to go after those kinds, because those kind of investors are like business investors. They're in the business of investing, and you're competing against all the other deals that they're looking at. And so they'll make a decision based on market size, market opportunity, your competitive advantage, your intellectual property. That's when you have invented something. Do you really understand your customer? What's the cost of securing that customer? They look at all these factors and the terms. What's the valuation? Or is the value of your company is $1 million? So that when you're going to raise 250,000, and let's say it's 10 investors putting in $25,000 a piece, then that's going to be 25% of your company if you're $1 million valuation, right? So that's kind of, it's a percentage of, do the math. And then your post valuation becomes $1,250,000, right? Because they add that into the value. And then the next time you raise it, that's the value, the baseline, but you try to increase it so that when you go to get a $500,000 or $1 million round, you're giving up maybe another 25% because you're now at a $5 million valuation, right? So that's kind of the basic math of traditional angels and how they work. But when you get into the world of crowdfunding and peer-to-peer lending, so there's organizations, I think Cabbage might be one of them, and this is where you might find those kind of investors that would do that bridge financing. So it's a person-to-person kind of, they don't think of themselves as angel investors, they think of themselves, and I actually did a podcast on this a while back, it talks about this guy that he basically, through the chamber, he just kind of put the word out that said he was willing to do, simple financing, that he got paid back within 6 months or a year. And so somebody not needed to go buy a forklift for their warehouse. He financed the forklift, right? And they paid him back. And he just rotates his money through helping the businesses in his community. And I put that out there as a way for a person to be a compassionate capitalist and get involved in investing in entrepreneurs without the long-term play of a traditional angel that has to wait 5 or 10 years to get the return on their investment. It's for anybody that's listening out there that is very profitable in their business. It's a great way for you to diversify your portfolio and not just invest in real estate, or maybe because, real estate takes a lot more upfront cash. So you could, if you wanted to, you could be doing something like this with $10,000 and rotating it around till you had a nest egg of 25 or 30 or 40 or $50,000 that could allow you to buy a commercial piece of property or something, right? So you can use investing in entrepreneurs as leverage to go do something else, or likewise money that you're making off of other things, because you might already be diversified in real estate, and you can put that to work in helping entrepreneurs in your local community, be that. So you've got a peer-to-peer thing that's they're out there, right? And then you have crowdfunding, and with crowdfunding, here's how a decision process for, aren't you glad you asked me one question? There's the decision process for entrepreneurs on that is, it is not easy to raise money on a crowdfunding platform, bottom line, whether it's reward-based or equity-based. And because you have to do a lot of work to generate the eyeballs. So anybody listening, and you think about the process you do to sell a product on your website or to sell a digital course, and how many eyeballs do you have to have that convert into somebody that looks at this or signed up? I mean, I'm going through that now. When I discovered how many people are coming to my website and not opting in, I'm like, what's wrong? And so, it's like, how many eyeballs do you have to bring in order to get that lead, to get, right? You go down your funnel. Well, with investors, it's the same way when you're doing it on a crowdfunding. So you have to have a plan of how you're going to communicate what you're doing to a large group of investors, potential investors that are interested in messaging it, that they're interested in whatever you're doing. The best way to do that is if you already have a tribe, as they call it, right? So maybe you're selling a consumer product online, you're selling a healthcare product or a beauty product or, something like that. And you've got customers already, but you want to bring out new products, or you want to go and get into retail stores, and you've got to do, other stuff with that, right? So the best way is to go to your tribe and say, hey, I'm giving up. You can have a piece of my revenue stream, and you structure it as a revenue and not necessarily an equity play, because you don't know when or how you're going to sell your company. And so, that way they come in, they get paid a little bit back, like an annuity, right? They get paid a little money every month on that, and you can accumulate, and you just, it's all about the messaging and selling them on the potential future of your business, the same way you sell them on the benefits of a product, right? In the similar process, right? And I can go into the types of crowdfunding you want, but I know you got other questions.
Yeah.
Did that address what you were looking for?
Yes, that's awesome. So as far as types of business funding, so we have SBA, we have angel investors, we have crowdfunding, we have peer-to-peer funding, and of course we have the banks or credit cards company. But is it typical for a B2B business owner to look for other ways to fund their business? Because I feel like, based on my observation, I feel like most people, most entrepreneurs who are seeking angel investors are, most of the time, they have products, they have invented something. So have you met a few business owners, who are in the B2B space, who have, asked investors to fund their business?
Yeah. So interestingly enough, when I first got started really in the space and understanding the space, I met this actually was the guy that invented the super soaker. Okay. His financial guy. And what he invested in was services businesses. He invested in he had invested in a temporary services business, and that had grown, and he liked it because he understood the business. So here's the thing to think about if you're in that particular situation. What is it that whoever you're targeting, what do they understand, right? If they already understand your space, or understand it, in this case, potentially a customer that you're providing the services to, they already understand it, and they like your business because they're a customer, and they understand the space and the value, and they go, oh, I believe that there would be a lot more people like me that would want your business if they knew about it. So if you could fund a campaign that ran a little commercial on TV, on the local TV, or you were going to run something where they do the commercials in the movie theaters or something like that, that was going to reach out, but you need $50,000 to do a year's long worth of a media buy. Like, I have a partner that sells discounted media, and it'll go in like your local billboards, or on the things on the trains, on the subways, and it could be advertising your business, and you're growing it, but it costs money. And if you're cash flowing and you're paying for your stuff, but you don't have an extra to do $2,000 or $3,000 extra a month in advertising, or $10,000 or whatever, depending on your size of your business, then you got to go find that someplace. And banks are going to be they're harder to finance a services cash flowing business because they're looking at, what assets are there, right? And so you have to personally guarantee it and use your house and all that kind of stuff. And that's awkward for people to want to try to do that.
Mm-hmm.
Whereas, you can work out different, it's flexible with the investor, particularly if they're an investor that likes your business. Or say, or for example, I've used this example, and I think I might have even used it in the book. There's a restaurant that you love to go to, and they want to expand and open up other restaurants, and it costs money to expand that, right? Or they want to franchise it. Somebody wants to franchise their services business, right? And that costs a lot of money because legal fees and things like that, and advertising and stuff like that. So you work with the people that know you already. I've called it a tribe before, but your best sources of potential investors are either people that you know through your business associations that respect you as a business leader, respect your business, understand it. You got to be willing to completely disclose all your financials and be very transparent about that kind of stuff, and the plan of what you're going to do with the money and where it's going to go. And then you just reach out. It's really reaching out to the people that you know, because your traditional angels will not, highly unlikely to invest in a services business, even somebody that's getting ready to franchise it. But there's other businesses, other people out there that will. It's just a matter of really working your network and understanding them, and and talking to them about what's the financial benefit that they're going to get and the timeline of when they're going to get it. So it's not dependent on you selling your company. They're going to get some kind of structured return on investment that they have the transparency to look at and see, that it's coming out of your business in a certain way, and then structuring it that it's all about they're going to write a check out of their checkbook. It's like, what's in it for me? And so that's the question you have to ask them. And then it's not as much as instead of calling them an investor, some people might use the term silent partner. Oh, would you be my silent partner? Because people kind of know what that is, and it's not as threatening in a way as being an investor. Oh, I don't invest in businesses, because they'll exclude themselves because they think of what an angel investor is, and I'm not an angel investor. Oh, I don't have that kind of money, or I'm not a tech guy, or these kind of things that they say in their head that exclude them from that. I mean, this is the problem I'm trying to solve in bringing more investors into the marketplace and explaining to people all the different ways that they can be an investor. And so part of it is also on the entrepreneurs understanding that they can talk to these folks as in this way. And one of the things that most people don't really understand, because when they look around and they go, oh, I don't have that kind of money to be an angel investor. Well, what they do have is typically a 401k or an IRA.
Right.
And if their IRA is set up as a self-directed IRA, they can direct the money in their IRA to go into that business. So it really works well when you have one of these royalty financing things or revenue things that's going to pay back, because when they invest in their self-directed IRA, that payment goes back in, and it goes back in tax-free. Nice. So that becomes a real benefit for them. The reason why they know about investing in real estate through their self-directed IRA, and sometimes people set it up, they'll take money out of their 401k and put it in that specifically for doing real estate, but they can also invest in entrepreneurs the same way, right?
That is awesome.
They don't know about it.
Yeah, that's so good to know.
Hello.
Well, thank you for sharing that with us. That's a good information.
Are you sick and tired of being overwhelmed and afraid you'll never scale your business? Meet Smart VAs. Unlike many virtual assistant agencies that only assign one dedicated virtual assistant, we provide flexibility for growing businesses by assigning a team of experienced virtual assistants that can do different tasks to support your continuous growth. Visit smartvas.online to book a free discovery call and start growing your business.
So, is there any minimum amount that I should need before I reach out to an investor? Like, should it be 20K, 30K, 50K? What if I only need 5K? Is it worth it to find an investor, or should I just contact a bank?
I mean, it really depends. It depends on if you are, because it might be, if it's short term like that, getting a line of credit, it's nice to establish. If you don't already have, okay, let me answer it this way. If you don't already have a line of credit or a relationship with your bank, it would be good to go, if it's a small amount like that, to do that, because by establishing that and getting business credit worthiness, you start to set yourself up for other types of financial options through the banking system. An SBA loan is still a bank loan. It's just part of it is guaranteed through the government, but they still go through the rest of that. Does this person, even though 80% of it's guaranteed through the government, they still look at, can you qualify? Would we loan you just this 20% of it, right? Mm-hmm. So if you have a banking relationship with them, then they start to look at that and they go, oh, well, they were good here, so now I can lend them more than we would have before. So sometimes you can use that strategically that way, and it's better than a credit card. Particularly if you can set up as a revolving, because then you just use it when you need it, and the interest rates, and it's counted different when it comes to establishing your business credit history, right? Mm-hmm. So that's that first question. And then and you're going to have a business plan for all of that. So you have to think about, are you going to write your own business plan, or are you going to hire somebody to do a business plan? And hiring somebody to do a business plan and doing your financials could cost you thousands of dollars.
Yeah.
And so, then it's kind of like, I just spent $3,000 to get $5,000, right? So then you have to see, it's like, it should be higher, more money than you need, but you have to be able to warrant, what are you going to do with it that's going to generate that whatever return you are proposing to your potential investor or investors, right? Yeah. So that's an element of it. If you're doing something with investors, then you have a legal cost for the documents. You're going to need to, if you're selling equity, you have to have a subscription agreement. You have to have your company structured with equity shares, that you usually do. You set it up when you incorporate with your state, but they kind of default to 100 shares or something like that. So most people aren't set up with the right number of shares if they haven't thought about this ahead of time. And you usually want to have like at least 1 million shares if you're going to be raising capital. You have to sort of look at, well, am I going to do this? And then I'm going to do this, and then I'm going to do this. How much do I need? Because you only authorize a certain amount each time you raise capital, and then you issue the shares. Right. So even though you got a big number, they're held back. They're still held back by the company and owned by the company. You mm-hmm. as a person, as a member of the company, don't own them. The company owns them, and you have your own shares. So you might have yourself set up where you have 70% of what is authorized until you sell that other piece of it. Okay. So you have to think through that. There's a legal cost associated with it. If you're just doing something simple, like we talked about with a loan, then you could probably, I love the folks like Legal Shield or Rocket Dollar that are really low cost legal services, and they have templates, and mm-hmm. then you can just, for $25 a month, or I think Rocket Lawyer is like $100 a year, and then you send it to them and they review it for free for whatever your membership is. And every business should have something like that for their own protection. You can review contracts, right. Things like that, right? Legal Shield also offers stuff for your family, wills and things like that. That's kind of nice if you're a family business or a home personal business kind of a thing. So, associated with that, if you're going out to a regular lawyer and you're doing, documents to sell equity in your company, it's going to cost you a minimum of $5,000, usually $10,000 to $20,000.
Wow.
Right. Okay. See, so, that's associated with it. That's the reason why it's usually the angel investor world is reserved for those companies that are going to become $50 million companies, right, or bigger, right? And so, exactly. But if you're a $1 million, $2 million company, or say you're a few $100,000 now, and with this funding, you're going to go become $1 million or $2 million company, that's a really good lifestyle business. And that allows you the flexibility to invest in other things. And you could do that pretty easily with a couple page agreement with that investor or group of investors that are going to provide the capital that you need to just kind of get you over the hump. Or as I mentioned earlier, for inventory financing or things like that are kind of hard to get sometimes if you haven't yet sold a big order, right? If you've just been right. And then with crowdfunding, if you're doing a Reg CF, some of the services, so that's the one that you can general solicit up to $5 million anywhere in the country for accredited and unaccredited investors. And that means it's based off of income, right? And if they don't make over $250,000, $300,000 a year, that's proven with their past income, right, earned income, then they're what they consider unaccredited, and they're limited in how much they can invest. That's really the difference, but they treat them all the same once you are taking that money in. Most of those services take a piece of the back end. They have minor fees, like maybe $500, and they will set up all your legal work for you and do all of that stuff and report it to the state for you for that fee. And that's why they get the percentage on the back end. But when you're raising money that way, you have to remember the marketing cost of pushing it out and promoting and getting those eyeballs and planning it. That's what you've got to plan ahead. So you might go to somebody that's a customer and say, hey, I'm going to do a Reg CF. We're going to raise $1 million with this, but I need $20,000 to pay for my marketing and get all my marketing collateral and my professional video done and all this kind of stuff. Will you front me that, and I will pay you back when I get this money out of my Reg CF, and I'll pay you $40,000 for giving me that $20,000 now. And they'll be like, yeah, sure, I'll do that. Tell me your plan. Let me see how you're going to do this. How are you going to get the eyeballs to do the, whatever. They may not even know it. They may not, and you can kind of get them on a motion to do that. But that would be the way to set that up, because you do have to have an investment in marketing to push it out in social media, to run these little digital videos that get put into the stream based on people's preferences. Oh, I'm looking for skincare products. And so then when they go and they do something on YouTube, then it inserts your ad in that stream that says, oh, here's my great product. And oh, by the way, you could have a piece of my company and go to the stars with me, kind of a thing, right?
Yeah.
That kind of a deal. So you have to have your strategy of how you are going to market that. And then just real quick, the other equity-based ones are there's Interstate. So you can look and see what you have in the way of your state. Just Google, your state and Interstate exemption. And every state has them now. Some of them make it really difficult to do that, but it basically means that you could advertise, you could put something out to all the members of your chamber and invite them to a dinner and drinks kind of, appetizer thing or a breakfast meeting or something like that, where you pitch your company and say, hey, I'm looking for silent partners in my company. And for $5,000, this is what you're going to get. And you can send that out. You could advertise that. You could do direct mailers to the richest zip codes in your state to get the most money people. Again, you got to have some money to do a direct mail. Right. You got to have money to do all that other kind of stuff, right? And maybe you get your bank loan to do that while you push that out. But you can raise up to $5 million with an interstate exemption of accredited and unaccredited also in your state. So sometimes they'll do it through their church, right? They'll because their church is one that says, I want to support the community. They may do it in their business association. They may have other associations that they're a part of. But now you can, if you do it that way, and typically it's very simple paperwork that has to be filed with the state. In Georgia, I have a lawyer I work with. It's $5,000 flat fee. She puts all the stuff together, registers with the state, and sets you up to go and do that, because it's a much simpler legal agreement than what you would have when you're doing the other kind of equity. And then there is a 506C, which is not used that often because it's only accredited investors and they have to prove that they're accredited, and you can raise unlimited amounts of money on that. but it's harder to do to get. It's a more difficult mechanism. And then there's the Reg A plus. So any company out there that's listening, and this is the hot, best kept secret right now that shouldn't be a secret. You can raise up to $50 million, accredited or unaccredited, through a year, a calendar year. And you can general solicit all over this country on that. But it's really ideal because you have to file SEC audited financials.
Mhm.
So there's certain accountants that can do that. And so they're big institutional investors look at that as if you could be a public company, but you're private. And they think that is like really getting in on the inside scoop of a company that has potential to go really big. So it's ideal for those companies that maybe raised a little bit of money already. They're at that $5 million, $6 million thing. Now they're going to franchise, and they want to do a national campaign and launch their franchise. They want to acquire another company. They want to do something that's going to take them from being $5 million to $20 million and raise a bunch of money, like within really short order. So it's a real line of sight of what they're going to do with that. They're going to bring all their manufacturing into the United States and buy a bunch of equipment and hire a bunch of people, and it's going to reduce their costs like this, and their supply chain is going to be faster, and they're going to blah, 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 blah. All that's whatever it is. Reg A plus is a really, really good solution. And then if you don't have to go public, but if you want to go public, it's just, filing another piece of paperwork. And now you can be out on NASDAQ and stuff better than, never do. Anybody thinking about doing a reverse IPO out there where they reverse merger, where they merge into a public shell? Don't do it. Do a Reg A plus. It's much better because you're creating your market and you're growing your customer base at the same time. So the same time you're advertising that on a national basis, you're now setting yourself up to be acquired, because now the private equity firms know about you and they're like, oh, they're doing this. And so when you get to that 20 million, they're going to be knocking on your door saying, hey, we want to look at buying you.
Yeah, that's awesome. Well, I know, like, getting an investor, to fund your business, seems like it's gonna really grow your business if you do the right things, right? If you have a business plan and if you really act on your business plan. But it's not always rainbows and butterflies, when you run your business. So what if you have an investor, you thought that, you think that you're going to grow your business, but after a year or two, your business doesn't grow, as fast as you think it would. So what happens if you're not able to fulfill your commitment to your investors? What happens if you can't pay them back?
Well, if you did it on an equity basis, then depending on what the terms were for that, they could have preferred rights on your intellectual property, right? You would in effect have to go out of business, okay, to get them out of your company. If you did it in what we talked about with some of the loans or kind of royalty financing thing, they might be annoyed, but they're really, if they don't have as much recourse other than because if they could put a lien on your business that says you have to pay them, but you should already be paying them, right? And so they have to get in line behind whatever other lenders are on that, unless they might, if they're smart, they would be setting up in the agreement that they get first position on any claims, for payment in the course of a bankruptcy or something. And other than that, I mean, that's why it's really important to plan what you're going to do with the money. So
Right.
like, for example, if part of it is that you're going to, like even in your case with the virtual assistants, because you have lots and lots of different kinds of virtual assistants. And so with this money, I'm going to update my website. And I'm going to bring on a temporary calling person to make telephone calls and increase my sales thing. You need to know what those costs are going to be. You don't incur those costs, but you get real proposals on what is it going to cost to do this. I'm going to launch a podcast that's going to bring in more information, and I want to do it professionally. What is it going to cost to do that? So you got to figure out what all your costs are, so you don't get into a situation that when you get the money, you're going like, and then you go out to try to spend it and you find out it costs more than what you thought it was going to cost. Right. And then you've had to use, there wasn't as much of that money as what you thought. You know what I mean? It couldn't get you through the payroll of 10 months of these new people.
Right.
Versus it only got you through 3 months because the website cost $3,000 more than what you thought it was going to cost, and all of that. Right. See, so it's really important in planning it. And that's part of the business plan stuff. Right. Even if you're going to hire somebody, like I have a tool that I use that I recommend to people. And I'll just say right now, anybody that's listening that wants to have this, like, hey, what about me, Karen? You can go to my website, opt in on the contact page, and you'll get an email with a link to my calendar. And I do 30 minutes free, have a conversation like that. Right. And I'll send you the link to the business plan tool I use. And it's a collaborative tool you can use online with people. And it kind of prompts you through asking questions, and you fill it in. And then it comes up with this document that you would never give to anybody because it's all bloated and it's got really bad languaging and stuff in there. So you have to just wordsmith it. But sometimes it's hard for people to go, I don't know what to say, or did I say everything? Or how do I talk about my marketing plan? So it asks you questions, and then you, based on your industry and stuff, and it's not really an artificial intelligence tool. It's just a semi-intelligent tool. And so you get that, and you just sort of figure out exactly what you're going to do. Look at your current financials. What is it going to do when you incur? You have to create a forecast that says, this is what I'm going to do with the money, and you put it in those expenses, and this is what's going to come out of this revenue, right? And so you should have all of that, and then that should inform you of the odds of success when you take on this investor's money or you take on this obligation. And so it's best to do it in bite-sized chunks, because, getting a $10,000, like having them guarantee your purchase order financing to expand this, or you need them to be the guarantee on your SBA loan or something like that. And they may use their own assets of their stock portfolio. There's some organizations out there, some financial services organizations that allow investors to provide lines of credit to people themselves or people in their family based on the value of their assets that are held there. So they may set you up as to be that line of credit, and you're paying the loan back, but you're giving them a little extra something, right? See, so, when you do that with a little amount, then you earn the right to do it on a bigger amount because you pay it back, and you get more comfortable with the uncertainty of taking on this obligation, because you should feel as obligated to pay any investor that loans you money as you would a bank. Right. And the same sort of recourse a bank might have to go and put a lien on your house or something like that. Investors don't want to do that because they don't want to put a lien on your house. They don't want your house, but they need to have some form of a guarantee. And even if it takes 3 times longer to get that return that they're expecting, then that's okay. You're still going to do it. You just the best thing is to stay in communication with them that says, hey, look, I didn't foresee this. I didn't know we were going to have a pandemic. You know what I mean? And all of a sudden my business shut down, or I couldn't do this, and I have to pivot to do this other thing. We were going to do a launch in stores, but then nobody's going to stores, or whatever it's going to be. It's going to take 6 months more. Would you give me another $5,000 to see it through that as a way to hedge? And this is what I'll do to guarantee that. I'll sweeten the deal because they're already invested. Sometimes you can go back to them if you're transparent and communicate with them on a regular basis on your progress and what you're doing. Update, here's the new version of the website, that kind of a thing. Right. Investors get anxious when you don't communicate and they don't hear from you.
Yeah, right. That's awesome. Well, as we wrap up, I know you already mentioned about going to your website and filling out a form there. Tell our listeners how you can help them if they are seeking help, to fund their business, and how you can work with them.
Okay. So yeah, Again, it's karenrands.co. You can see it on the video, and I'm sure it's in your show notes. So free consultation. Beyond that, I do business plan review. You've written your business plan. Is it investor ready? Is it something that investors are going to be appealing to them? Do you have a pitch deck? If you're doing investors, usually have to have some form of a pitch deck. Sometimes people use their pitch deck as their business plan kind of a thing, and there's a way to do that. So I have a fee that I charge to review it and give you feedback and coach you through that. I also have a coaching program that is about a 5 to 6 week, depending on the needs. It's customized to the entrepreneur that helps them get their business documents together. I have templates for the securities documents that they can fill in and go and take to their lawyer to review. I have, and it helps them get over the fear of asking for money, because you're going to start out always with what they call friends and families and your business network. And so how do you approach them? Because you maybe never had a conversation about money with them before. So how do you go about approaching them? What's the language that you use? Role play, we create your list, help you do that if you're at that stage. It also is if you're in business and you're growing, what kind of crowdfunding should I do? How do I set that up? And then we have customized services for running your crowdfunding program. And I become the quarterback to get you your video, get you your thing, push it out there, do the media buys, all that stuff that needs to happen to launch your program and how to do that. Because I should tell you too, when you're doing Reg CF, you have to go through their broker on that. But you don't get your money unless you raise all the money that you said you wanted to raise. Okay, you get none of it. So it's just sort of held. So you could spend, if you don't do it right, you could spend money launching it and not get that. All the other ones, you get whatever comes in, even if it's less than what you wanted, right? So, I do those kind of customized programs and help quarterback that for folks to run that and be an extension of their team. What do they need to do to change their website, add an investor relations page, things like that, run that. I use a CRM system to have their investors that are interested, similar to what they do on crowdfunding things, but they come in and you're now your investors for you to communicate with, like you do with customers, on your progress, because they may be waiting for certain milestones to be met or certain other information or other investors to commit before they wanted to commit. It's always hardest to get the very first money in. So, we offer that. I recommend people just go to karenrands.co. Let's have that first conversation and let's see what you need. And if I can do it. And if I don't think I can help you, then I'll tell you that, and I'll tell you what you should do, because there's a lot of incubators and accelerators and different things out there for companies to go get the help that they need in their community, and other kinds of free resources or for fee resources that they can do that might be more appropriate.
Yeah, right. The first step is to go to karenrands.co and see how Karen can help you out, in your business. Well, thank you so much for everything that you've shared, Karen. I was like 50% of what you shared. I was like, this is way beyond my pay grade. So that's why it's important that we talk to, that I talk to somebody who's expert in what they are doing, right? So thank you so much for sharing all those valuable information, Karen.
Yes, absolutely. And I really do appreciate it. And if any of those people I mentioned about investing, if they are thinking about that because they have extra liquidity, then get the book, Inside Secrets to Angel Investing. It's a primer to figure out would you, should you, could you. And so with that, Kristy, thank you so much for the opportunity to share this information to your audience. It's so critical to get this kind of information out there, because there's just so few people that even know that any of this exists or how to use it.
Exactly. Thank you so much, Karen.